So Sam, how are you?
I'm all right. As I said off air, I'm a bit tired, everyone. I'm sorry. I'm moving house at the moment. And for anyone that's done that recently, yeah, you'll know it's hard work. I'm doing it on my own as well. I've got no help. So I'm moving stuff about. So I'm a little bit red-faced. And it's a good thing we don't have smell-o-vision. But hope, hopefully that won't deter from getting all your questions answered, and hopefully everyone can take something away from this. That's the most important thing, right? Everyone's watching, just learns just one little thing new, or maybe a few things new, but just taking one nugget away is the most important thing. So I'm here to do.
I've got to ask you, Sam. I was telling you off camera that I worked for a removal firm on the back of the lorries moving people houses during COVID when I got made redundant, and I got the nickname Crash Bandicoot for basically knocking furniture off every wall on the way out. Have you had any breakages or damages during the move yet, or has it all been plain
No,
sailing?
no, but I no, but I can tell you about a bad one. Like I said again off air, I used to I've not always had pristine hands. I used to actually work with them. I worked for my dad. My dad's been a builder for God 50 years. And I used to work with him. I remember going to a really nice house. It was sort of going towards Edmonton Way. If anyone's from North London, you'll know. And it was a really nice road, really big houses, all detached houses. And yeah, Dad asked me to. He went off to get some supplies. Asked me to chisel out all of the old uh, socket boxes out of the wall because we were going to redo the electrics and stuff. And I I didn't realize how thin the walls were, so I ended up chiseling out one a bit too much. Went straight through the wall into the living room, completely ruined one of the walls, and then that my dad had to redecorate the entirety of the living room free for them. So everyone makes mistakes. That was mine. I learned to be a bit more careful with a chisel from then on, and didn't use the Makita drill as often as I used to.
Yeah, that sounds like definitely something I would do. And I'm sure you've probably got a good insurance broker as well for public liability insurance going forward.
Absolutely, absolutely. You've got to have one. You've got to have one.
100%. So Sam, I'm going to take this right back to the start in terms of what a HMO is just in a second, because I think it's really good we clarify exactly what a HMO looks like, just for anyone that's joining us that might not be as experienced as some of the people we've got in the audience. But could you just give a bit of insight into who you are, what Grand Union Finance is all about, and yeah, how you are servicing the industry at the minute?
Yeah, cool. So I started Grand Union Finance nearly 6 years ago now. A couple of months' time, it's going to be 6 years. I've been in the industry nearly 20. For all of you history buffs, you'll know that was a terrible time to get into finance just before the credit crunch. Well done, me. That was hard work for a few years after that. But very quickly, I got into the sort of the developer investor side, and obviously over the course of probably the last 15 years, HMO has probably been one of the, if not the biggest buzzwords, I'd imagine, in property investing over that period of time. And so it was inevitable that when I started going to all these like property meets and stuff, I was hearing the terminology and I was getting those inquiries. People were asking me, how do you mortgage these HMOs? Is it basically you just use a buy to let mortgage? And I, just like everyone else, had to go out and learn this stuff. But luckily, I learned it quite a long time ago. And since then, as an organization, we very much specialize in helping HMOs, HMO investors, because we can help with all the different bits of finance that they need. Because a lot of the clients we actually work with, they don't buy just ready-made HMOs. A lot of people do, and we have got clients that do that. But a lot of our clients actually buy C3 family homes, and we help them finance the conversion of those C3 family homes. In fact, some we've got clients that actually buy like commercial property and convert them into like 25 bed, 30 bed HMOs as well. So there's a big HMO, there's a big old spectrum of different types you can do. And it caters for all, I think. But I guess going back to the simplicity of it, like you said, essentially an HMO is just a property where multiple people reside in it that aren't necessarily related. So it's not a family home, is it? It's a house, usually a house. It can be flats, where multiple people, anything from three upwards, generally. Although different local councils have different viewpoints on where that starts, but certainly from a lending point of view, generally three and up is where it starts. Although we've got buy-to-let mortgages for four-bed HMOs before, because some lenders will view those just as buy-to-lets. But generally from a lending point of view, there is a bit of a difference in criteria when it comes to mortgages, and I'm sure people will probably have quite a lot of questions on that. So I won't delve into that too deeply just yet, because we'll have plenty of time to go into that as my light goes off in the office. Um, um, but yeah, look, for the longest of times we've helped clients convert, refinance, and then refinance again and again, as well as acquire, quite quirky HMOs. And I think that's what a lot of people get confused about, is actually where do HMOs sit from a lending point of view? What's available? I mean, I'm sure the commercial valuation question is going to come up, because you just sneeze the word HMO and somebody mentions commercial valuation. So we can certainly touch on that, because that's a really, really interesting point, and particularly on what you mentioned earlier on about Article 4 and how that changes things, and also lending appetite, because we mentioned before, you said earlier about kind of not wanting to go down the political thing, but HMOs have got a certain rep, haven't they?
Mm.
I stupidly commented on a Facebook post the other day where somebody said about HMOs, and said the reason people don't like HMOs is who resides in them. So I commented, who resides in them? Because I genuinely believe people don't know who resides in these HMOs, because a lot of the time it's professionals, nurses, doctors, aeroplane staff. It's not bums like people think there are. And I think there's going to be a huge, huge, huge need for HMOs over the next decade, as renting becomes a lot more expensive, as just renting a flat as a single person becomes, people are going to get outpriced. Unemployment's going up, the cost of living is going up, the rate of divorce is going up. I think there's going to be a hell of a lot of need for HMOs. So certainly lenders know that, and the appetite is still very much there, but there is criteria that we obviously have to follow.
Well, me and you've done a lot of networking over the years, and there seems to be a real shift in the last few years. When you would go out originally, a lot of people would say, "Oh, I'm a buy-to-let landlord. I'm a landlord. I own a portfolio of properties." And it was, maybe 1 in 10 you'd speak to, they'd say, "Oh, I've got a portfolio with a few HMOs." And you go, "Oh, right, quite interesting." Now, when you speak to people, it's almost that most people building sort of a rental portfolio will have HMOs as opposed to buy to lets. It seems that the HMO strategy is overtaken trying to go just down the traditional buy to let. And I think, would you say it's probably the yields that have attracted people most through that?
Do you know what? I think there's a few different things. I certainly think the yields, of course, they do. But secondly, the BRR type strategy, the standard buy-to-let portfolio building, has become a hell of a lot harder. I was talking to our friend Tony Walker the other day about, the cost of materials. And, when you're buying a family home and turning it into a slightly better family home to try and recycle cash and then rent it out, that strategy doesn't work as well as it did 10 years ago,
Mm.
and in certain areas doesn't work at all. It's almost impossible to recoup funds that you put in, which when people are trying to build a portfolio, because they're trying to build a group of assets that they can hold for a long period of time, you then have to turn around and go, well, hang on a second, how am I going to do that? And I think that's what the best investors do. I'm lucky. I speak to investors every day, even lugging sofas up and downstairs today. I was still on the phone to investor clients chatting away about their deals and stuff. I'm very lucky. And a key difference, I think, with the really top level investors is their ability to pivot based on keeping sight of their goal and pivoting accordingly. And I think that pivot has happened with a lot of people that are savvy recently, because they've seen that their end goal is to build a portfolio. They turn around and go, well, how am I going to build that portfolio? And it's easier to a degree to build that portfolio quicker when you're following that BRR, buy, refurbish, refinance type formula, because that is what HMO conversions is as well. It just is a more complex or a more advanced version, you might say, but the fundamentals are the same. But then you're getting the same similar returns as you would previously. Plus, from a funding side, it has become, I believe, more like the barrier to entry has lowered. There are much more. There are many more, I should say, lenders that are happy to lend to first-time investors. There are even more lenders out there that are happy to lend to first-time buyers, first-time investors. There are more lenders out there happy to do sort of commercial valuations on C4 HMOs, whereas that really wasn't a thing before. So in terms of certain areas where commercial valuations are going to be higher than bricks and mortar, potentially allows you to recycle more and more of your cash. You can find more money in, money out deals. So I think if your strategy is to build the portfolio and grow the portfolio, looking at something like converting HMOs starts to make sense. Now, look, there are loads of downsides to it, of course, which is that it's a lot more admin. But the best clients that we have at Grand Union, they see this as a business from day one. They start building their own management teams. They start building their own lettings teams. They don't. They vertically integrate this stuff into what they do, and they build from the start out. And that's how to do it, I think. And there is an economies of scale side to this. I mentioned earlier on about clients that we work with that are doing, larger conversions, 20 plus. These blocks can sometimes be leased out to organizations that will house people in there. Social housing is obviously another buzzword that we talk about a lot at the moment, or corporate leasing or whatever. And that's if you've got the cash to be able to deploy to start those kind of projects off, that's an amazing way of building a large cash flowing asset business. Um, you know, quicker than BRR basically. And I think that's what's enticing a lot of people is not just it's you talk about pull and push. There's the push factor, and there is the pull factor as well, because BRR is not doing the job as it used to. HMO is still there, doing that job in a slightly different way.
One of the things that I've seen emerge in the last few months, maybe in the last 12 months, is the terminology around co-living, which HMOs, where you like them or love them as a strategy, they do have a bit of a reputation fueled by the tabloids at the minute. And one of the sort of terms that I keep hearing is co-living. And I just wondered, is HMO the exact same as co-living, or does a lender distinguish differently? Is there a different, are they different strategies?
It's a hard question. The reality is, it's like anything. You can get a, you could go and rent a toilet, or you could go and rent a beautiful home. Um, I see it almost as a little bit similar, but you just factor in things like amenities and facilities into that as well. Co-living, you probably got more communal space. Some of that communal space is probably focused towards working from home type environments. But you'll see, higher level, higher class of HMO. I took our videographer up to Manchester to see one of our clients' conversions, and just the little details in it. And it was their first one as well, but they knew the level. You look around and you see what else is on the market. They knew that they had to really achieve a really, really nice spec, because they were looking for work, professional people, not necessarily old school, doctors, nurses, professional, but you know, top tier individuals that were going to look after the place, etc. Just the finishing touches, just that little bit better. So I do think there's a sliding scale of quality, and how well you're going to do off the back of that will change. A lot of some people will purposefully go in at a slightly lower level because the area require, the type of people that are renting HMOs in that area won't pay for those additional amenities, but there are other areas where it does work. So I think, like anything, property is very much down to location. So it's about just understanding the local market and what's actually needed. But going back to your point about lending and valuing, I've seen it go both ways, if I'm honest with you. Sometimes you just get a lazy surveyor that will go in and go, well, HMO rooms in the area are getting £500 a month per room, so that's what I'm going to value this rental based at. Others will go in and actually have a look around and realize, okay, this is something a little bit of a higher spec, and therefore we can foresee that we're going to be getting a higher rent. We're going to be able to achieve a higher rent as a result. So it's hard, and particularly when we're looking nationwide, there's so many different pockets, different surveyors, but I think on the whole, it's one of those things that's probably less controllable than we would like. We can pick and choose lenders, surveyors a little bit, but it's still difficult to get that access. It's getting better though, which is good. But yeah, I suppose to answer your point, sometimes they'll be valued accordingly, sometimes they won't. But that's the same for any property, isn't it? When it comes to surveyors going around and valuing for mortgage purposes.
Yeah. And I'll get on to the structuring of funds and the sort of structuring of deals. But you mentioned something earlier that sort of really piqued my interest, which was that the majority of your clients are typically converting from C3. So I wondered if we could just explore that for a minute, a little bit more around the actual conversions themselves and what kind of use classes and what kind of properties that you're seeing the most opportunities at the moment. You said so it was mainly C3, but uh, in your experience, are there any sort of case studies that you can draw on that you've seen some really clever usages of properties and different class types that you've been
Do you know
converting?
what? Of other class types, I have seen commercial properties, offices, warehouses, that sort of stuff converted into HMOs. They're generally larger ones, and I think what we'll typically see there, and this is when it starts to get a little bit complex, but once you've done it a few times, it starts to make a hell of a lot of sense. A lot of clients on that side, traditionally, if you've got a commercial property and you convert it to resi, you convert it into apartments. Well, you can still do that from an HMO point of view, and what you do is you kind of create a block of HMO apartments.
Mm,
We've seen lots of clients do stuff like that. And that kind of there are pros and cons to doing that, but it helps sometimes to get around the sui generis planning requirements. So we looked at one back in the last year where the client was converting a kind of light industrial into residential. I don't know how this light industrial unit turned up in this area because like it was a residential area. I don't know who built it to start with, but converting it and they were basically turning it into three HMO flats that were all 5 bed on all en suites. So they were able to sort of get around the need for sui generis because they split the titles and all that kind of stuff. So they were classed as C4 properties in that area. So there are some clever ways of avoiding having to go down full planning outside of Article 4, using PD rights to convert to resi. Generally, they go down the PD rights first to convert to the flats, and then they go and get the PD rights to convert those flats to C4. So there's a process of doing that. But typically, I think that the deal that will work on the most, just because we see such a high volume of it, is just converting a C3 into a 6 bed all en suite. The six
mm,
bed all en suite is a sweet spot for a lot of our clients. So I think it's just a sweet spot in general because you don't need the planning. Outside of Article 4, you can do it in PD. You can still potentially get that commercial valuation on the back end. Just as a quick caveat to that, on the commercial side, everyone comes to me like, "Can I get a commercial valuation? Can I get a commercial valuation?" The first thing I ask is, what do you reckon the bricks and mortar valuation is? And they go, "Oh, X." And I'm like, "Right, should we do the formula to see what the commercial valuation would be?" Okay, we do it, and it's less. And I'm like, so why let's not restrict ourselves. I think there's this like holy grail nature to I need a commercial valuation. The amount of times where we've done that, and I don't want to like blow our trumpet too much, but I know so many other brokers wouldn't even bother to think about it. They just go, yeah, fine, okay. Then they go down the route of limiting the lending options to like four lenders that will do it. They're maybe a little bit more expensive. They get the commercial valuation and then it comes in much lower than they thought. And then they're potentially the back to square one, or they're losing money. They're not getting what they need. So the commercial value isn't always the holy grail, but the 6 bed also there's quite a lot of over the last sort of 5 years or so, we've certainly seen an increase in the appetite to lend what we would call a refurbishment bridge. So you've got traditionally, if you were going to convert something like that, you would just use a bridge, a normal bridging loan, to purchase it. And we'll get into why you need a bridge to convert HMOs because it's really actually very important. A lot of people just go, why not just buy it with an HMO mortgage? So we can get into that. But they'll buy it with a bridge, then they'll have to sort of fund the deposit and the works themselves because these projects aren't big enough to get like proper development finance on. With more and more lenders opening the doors with this refurbishment bridge, which essentially is money coming through the bridging funding lines, but having the setup, the structure of a development finance loan. So they're funding 100% of the works and a proportion of the purchase price, generally up to 75% of the purchase price. That's allowed, like that is perfect for an HMO conversion if you don't want to deploy loads and loads of your own funds into that deal. So the fact that those kind of loans are becoming more popular and the HMO conversion fits into the criteria for it because generally the criteria is that the works can't be more than a certain percentage of the purchase price. So maybe 70, 80 or 100% of the purchase price. And generally those kind of conversion projects will fit into that category. Whereas a development project, you're expecting it to be relatively speaking lower land purchase sort of value, and then the cost of the works to build, two, three, four, five, six houses or whatever. That's obviously going to cost a lot of money when you compare it to the purchase price. Conversion projects are less so, and so they fit into this category of refurbishment bridging, which is awesome for those that want to convert C3 to C4 HMOs because that's exactly what this kind of finance was built for, and it's just become so much more popular with lenders over the last couple of years. There are more lenders now doing it than ever before. I think the where people trip up is because there are more. There's unfortunately quite a lot of lenders out there that are charging quite a lot for this kind of finance because they're putting it under, oh, this is really specialist, and it's not. We had a situation recently where a client's mentor told them to go and speak to this lender direct. And I won't say who the mentor was, even though they're relatively well known. And it's just because they're getting a kickback from this lender, by the way.
Yeah.
And I said, go and have a chat with them. That's fine. But let me do my research as normal, and I'll come back to you with the best terms I think are most appropriate for you. The difference was just astronomical. This other lender was charging 1.18% a month, a 2% fee, and a 1.18% exit fee on top of that. The lender we found was 0.75% a month, 2% in, no exit fee. Like the difference in the cost of that was something like 30 grand for this project. It was humongous. So there is a real difference. And you can't always spot those from the outset. Which is why it's really important, I guess, to work with a good broker that knows these things. But it's it's a part of the market that's grown massively, and it's a part of the market that excites me because there's just so many use cases for it, and obviously the HMO conversions is one of them.
Yeah, I guess when you're sort of dealing with those percentages, that can literally make or break a deal. But Leander's raised a really good point. So you don't need a commercial valuation for a HMO.
You don't need one, and sometimes you don't want one. As I said before, it is the HMO commercial valuation. I think has just become like this obsession with a lot of people that that's what they're after. I think if we take it back, it's go back a few years. If it's C4, you're not getting a commercial valuation, and the reason why is because if you've got PD rights to convert from C3 to C4, you don't do what a lender would call a sort of a fully altered, fully converted HMO. So essentially, it just looks like a four-bedroom house, but you've just slung a double bed in the front room. So you've turned it into a five-bed HMO. If 6 months down the line, you're actually like, this HMO malarkey is quite difficult, actually. I didn't think it was going to be so time consuming. Oh, do you know what? Let's get rid of that bed and we'll just rent this out as a family home. You can do that. And then if a lender has gone for a commercial valuation on that, and the commercial valuation was more than the standard bricks and mortar, you could, in theory, be in negative equity at that point because a C3 property will be a bricks and mortar valuation. and suddenly the lender's massively at risk. So that's the reason why lenders don't like to do it. And I think when I explain that to people, they're like, actually, yeah, do you know what? That makes sense. Because a lot of times they're like, well, why wouldn't they do that? It's an HMO. Why wouldn't they do that? Well, they're taking care of their risk and they're taking care of you as well. They don't want you to be in negative equity because they don't want to have to repossess you when you can't refinance 2 or 5 years later, you know? So, yeah, and as I said earlier on, sometimes you just don't want one. Matt, one of my brokers, had a situation recently. The client was like adamant that they wanted a commercial valuation, absolutely adamant they wanted a commercial valuation, and we eventually were able to convince him that it just wasn't worth it because basically what he was saying the commercial value was going to come back at, which we agreed with because we did the formula, we checked it out, we did some research. It was like actually coming in probably 10 grand less than a bricks and mortar valuation. We went and did the refinance. We had more options available to us because we weren't restricting ourselves to just the lenders that would look at a commercial valuation on a 6 bed HMO. And the valuation actually ended up coming out at 20 grand more than what we anticipated. On a refinance, if the if the strategy is to try and pull out as much money as possible, we'll always put a figure on the application form that is above what we think it's going to come back at. Because in my career, I've had four, that's not four, that's five, four situations where the valuer has come back with a figure higher than what's on the application form. Two of those with the same client, so she thinks that she walks on water. But generally speaking, they're not going to. They've got no incentive to go above that figure that's written on the application form. So we put it up a little bit higher anyway. So we did that in this instance, and it ended up coming in 20 grand higher. So that's a great example as to, we potentially would have been in a spot of bother. He wouldn't have been able to pull out as much money as he did. That extra 30 pulled him out an extra 20, which you know is allows him to move on to the next project a lot quicker.
Sam, I watched you do a talk last year, and it was around Grand Union Finance structuring what an auction deal looks like. And you went through the timeline from start to finish, day one, day two, day three. And it was really, really exciting because you got to understand the structure of the deal and what happens over that period of time. I was wondering, maybe tonight, would you be able to share with us if I gave you an example of a HMO of just I'm in the process of wanting to purchase it, could you show me and the audience how you would deal with that and what to look out for, what to worry about,
Yeah,
what information could be needed during that process to the point of completion. So if you like,
yeah, yeah.
I'll pick a random example that's local to us that we know, and then we can go from it. Does that sound okay?
Sounds good to me, mate. I'm always up for a challenge.
Awesome. Right. So, based off what you've said tonight already, I'm going to go for a three bed, semi detached in Marston Green. So, it's next to the airport in Birmingham. And it's got off road parking for two cars. And it's got a garden that's probably about 100 foot, but it's overgrown.
Right, and the plan is to convert that to an HMO.
Yeah.
Well, number one, good plan is near the airport. You're going to get the only problem you're going to have is when you've got a load of air stewards and air stewardesses together, there's going to be parties in there. But
That's why I'm
can't get
buying
over
it.
that. Yeah, just not random knock on the door. Hi, it's your landlord. I heard some music.
Yeah.
Look, with that, that's I like. There's two things in that detail actually that you maybe aren't aware of, which is why it's really really interesting. So, did you know? Here's a little top tip for everyone. Did you know that one of the reasons why a lot of C3 direct to sui generis HMO planning planning applications get denied? It's because of parking. Because what a lot of people do is they'll buy exactly this example as we use this example two two car off-road parking, and they'll go, cool, so you want to turn this into a 7 bed. Okay, so at the moment that road has allocated there's going to be two cars going into that road, and potentially if they've got a kid they might park on the front bit or they might park just down the road. Well, hang on a second, you're now telling me that there's going to be 7 people living in there, potentially if there's couples 14, you know um people residing in that property, how many cars are there going to be? That's going to cause a problem, and that's generally one of the reasons why it gets those C3 to sui generis direct get cut off. The one of the really good ways around that is that you go in for PD first for the six bed. Then you, if you want to turn that into a 7, 8, 9 sui generis, you go for the planning afterwards because when a property is already moving towards being a functional six-bed HMO, to say to them, well, there's only going to be two more cars, that's more of a sell. That's an easier sell. Um, Probably want to have a chat with a local planning consultant just to sense check the stuff I'm saying. But so that's that. The fact that you said there's two room for two cars. What again? If you know what could deny even a PD is what's going on that road. Is there off road parking available? So always be wary of that kind of stuff. But I like the fact that you said there's a big garden, but it's a bit overgrown. What a ton of our clients will do when they're following that structure, where we are doing like a two-tier essentially. And what we'll do, by the way, on the finance on this is we're going to look at the back end and we're going to work backwards. So we're going to look at, right, what would the commercial GDV be on this property? We're going to sui generis this because it is near an airport. So getting an 8 bed, a 7 bed, 8 bed is probably a really good idea if we can get it. If it's outside of well, it doesn't matter if it's outside of Article 4. It does for the PD, but you get for this purpose anyway. Let's say it's outside of Article 4. We want to get a good group of people in there. Let's go for 8 beds. Um, they're going to look for properties where there is the opportunity to potentially extend as well. We've last year in Birmingham somewhere. God, it's going to annoy me where it was. I want to say it's like B60 postcode, but it wasn't. We did. It was the end of like it was like the corner of a road. It wasn't like an end terrace. It was an end semi-detached actually, and so there was room to the side and the back. So they did a full side, double side and rear extension, and they turned a 4 bed family home into an 8 bed um, HMO. But they did it on that stair step approach with the going in for PD, getting the C4, then going in for the planning for the extra bedrooms. So they were going to build it anyway. They just they just then needed to get the permission to rent it. So they did it like that. But what we did first is we looked at getting the finance based on the 8 bed GDV. But then what we did was the lender allowed us to fund the purchase, and then they said, right, we're going to look at plan B. We know you're going to get your PD for your 6 bed. So let's look at what the GDV would be on the 6 bed. And we did it on a commercial on the 6 bed because we knew we could. The client's experience allowed us to go with the lenders that would allow for a commercial. We gave the proof to the lender of that. So then what we did was we basically kind of had a facility within a facility. So the idea was that we have our plan B facility, which we're going to go with first, fund 75% of the purchase, then fund the that are required to get the property to a 6 bed HMO standard. Cool. Whilst we're doing that, they're going through the planning to get the sui generis and the extra 2 bedrooms. And then as soon as that comes in, lender changes the facility based on what we've already sort of had pre-agreed. So as long as it's got planning, we can then make the development facility bigger, incorporate the additional works, fund all of the works to do all of that, and that's how we did that all the way through from start to finish. And that allowed them to start the work whilst we were moving towards the PD. And then once we got the full planning, they were able to finish it off. I mean, it was a big project. They went into the loft as well to get the full 8 beds. In fact, there was 2 bedrooms in the loft. That's where they got the extra 1 bedroom in the loft. Yeah, 1 bedroom in the loft. That's where they got one of the extra bedrooms from. But they couldn't use that bedroom until planning permission came in for the sui generis. So that's kind of how they did it. And then on the back end, we just refinanced that um, onto a mortgage on a commercial valuation. And I don't remember if it was fully money in, money out, but I'm sure it was. In fact, I think they pulled out money out of that. And when we go back to that BRR comparison, getting a money in and money out deal on a BRR is basically, a unicorn deal now. Doing it like that, it's quite straightforward, quite standard that you would get all of your money out. Obviously, needed to put a little bit more in. It's a big house, lots of work. The works are funded in arrears, so you've got to forward fund to start the works off at least. So there is some cash that needs to be injected into a project like that, some skin in the game required. But if you can do it, and then on the back end, I can't remember what the rent roll was, but certainly it was another two bedrooms on top of that from what a six bed would have been. So it's a great property to add to their portfolio. They've got about three or four of those within their portfolio now, and yeah, just doing incredibly well. And it allows them to build that cash flow, and the cash flow for savvy investors is what funds the expansion of their portfolio. That's what they can refund, they can recycle the cash, but they'll eventually get to a point where every year, every 9 months, every 6 months, cash flow during that period of time will allow them for another deposit for another one of those projects. And that's when they kind of start sort of self-funding almost. We've got plenty of clients that are in that position, luckily now, but the graft starts at the beginning, and you can get to that point quicker with those kind of levels of HMOs.
Great. Guys, if you've got any questions for Sam, please do put them in the chat. We've got another one from Leander, which we'll get round to in a second. So, Sam, in terms of the deal and how it's structured, what would you be advising your clients in terms of the early stages? So let's take this house that we've got next to the airport in Birmingham, for example. We've got off-road parking, which is a plus. We've got a decent garden. We're not going to do a wraparound extension like your previous clients because we're worried about the fire access down the side. So it's had a pre-existing double-story extension on the rear elevation, which has expanded a third bedroom. So it was originally a box room and a bathroom on the back, but now they are more than ample size with three double bedrooms and a really big size bathroom. They're going to be split into six rooms. Sorry, five rooms upstairs and maybe one or two rooms downstairs. So we'll go six in total. I'm coming to
Yeah,
you with this deal. How are you? What are you going to do to ensure that I'm in the best position possible to get accepted by the
yeah.
lender?
Well, similar theme. We need to reverse engineer it. So the first thing we want to do is there's no point going and speaking to bridging lenders about funding the acquisition and works unless we know that we can get out of it. So first things first, we want to understand the basic numbers, which are what's the purchase price, what's the work cost going to be with 10% contingency, how long the work's going to take with a bit of contingency on top of that as well. What's the end rent roll going to be? That's a really important one if we want to get a commercial valuation. And what's the end? Because we'll work out what the commercial valuation is. We'll make certain sort of we'll allow ourselves a little bit of wriggle room on that. But and we also just want to know what the bricks and mortar GDV as well, so we can make a comparison to actually see which one works out to be the best. Now, let's say the commercial valuation does work. What we want to then do is before we even start going off again, speaking to bridging lenders, etc., there is only a handful of lenders that are going to look at these commercial valuations for a six bed, all en suite HMO, fully converted, as we call it,
Mm,
or fully adapted, as lenders call it, HMOs. So we'll go and speak to them. We'll get a floor plan. That's one of the first things to do. Get a floor plan, get it in front of them, and I just want in writing that they go, yeah, this is exactly the kind of HMO that we're going to consider for for a commercial valuation. That's what we're going to do first. Then we can reverse engineer. We know we're going to go for commercial valuation. We want to try and find out what the rough yield would be in the area. Generally speaking, this is quite a large spectrum. I get that, but we're probably looking at somewhere between 8 and 14%. So we want to know where in that spectrum roughly it is. If we speak to some HMO specialist letting agents and some surveyors, a lot of them will be happy to sort of give us a bit of an indication of that. So let's just say it was 10%, for example. We can work out what our commercial valuation is going to be. So we need the rent roll minus 25% generally take care of maintenance and management. And then we divide that 7.75 of the annual rent roll by the yield. That gives us our commercial valuation from a surveyor's perspective. And so that we've got a pretty relatively good understanding of what that's going to be. I would generally swing it one in either direction. So we work out what it would be at 9, what it would be at 11. So then we've got a range. Probably put the application in for the higher of that range. But hope for the best, plan for the worst type thing. Then we've got to then we can work out, right, 75% of that is what we're going to get as a mortgage on the back end. So we don't want to be borrowing more than that amount. Otherwise, we're not going to have enough to repay the loan. Actually, we want to have a big difference between those two so we can pull that cash back out. So that's when we finally can go to the front end and we can start looking at deal from a lender's point of view. And in a very similar way to bridging to development finance, which I know we touched on when we did the commercial to residential webinar before. Lenders are then looking at how are they going to limit the loan. The first one they're going to look for is the GDV. We can give them an indication of what that GDV is going to be, and most refurbishment lenders, in a very similar way to development finance, go somewhere around 65% as a limiting factor on that. So if our GDV was £1 million, our facility, if it was limited by the GDV, would be 650,000. That would be split between covering 100% of the works, and whatever remains can go towards the purchase price, subject to a loan to value maximum. However, and this might sometimes work with these kind of conversion type projects, is that the limiting factor may actually be what we call loan to cost. So we've got to work that out as well. Costs from a lending point of view is the purchase price plus the works. Whatever that is combined, generally 85% of that is standard for the market. There are some that will go to 90. There are some lenders that don't have that as a limiting factor, but let's just use the standard figures for the time being. If that 85% was less than 650,000 or less than 65% of the GDV, that would be our limiting factor. That's what we're going to borrow. That still needs to be split between the works. Lenders like to fund 100% of the works first because they want to make sure the works are actually going to be paid for and done. So they get that end product, they can be refinanced out, they can get their money back. And if they limit how much you borrow day one, you put more deposit in, then they know that that's still covered, and you've basically put that skin in the game then rather than later on. But generally speaking, a half decent HMO conversion project, you are going to be able to borrow 100% of the works, and let's say 75% loan to value day one. We can then from there work out, okay, if we keep the loan for the whole term, we're going to pay back X amount, and we know that if we borrow 75% of the GDV, that's going to be this amount. The difference is, you know, 50 grand, whatever. So we then know we can pay everything back and we can pull 50 grand out of the deal. Now, obviously, all those figures are subject to change slightly, but we've at least got a decent understanding of how that deal can be set up and structured. And we then know, and this is the key one for lenders on the front end, we know what the profit on cost is going to be. And that's basically the percentage, the difference between the GDV and the costs, i.e., the purchase price plus works. If that's above 20%, that's a good buffer. Lenders like that. Typically on a deal like this, I prefer to see 25 to 30, because I think deals like that are in existence and you should be searching for those. You want to be making yourself some good profit. If you're doing a larger development, you might be pushing for, say, 35, 40, something like that. But on an HMO conversion such as this, 20, 25, 30 is definitely where you want to be hitting at the bare minimum. So that allows us to kind of work that out as well at the same time. So that's how we would kind of structure it from the end, working backwards, having certain contingencies, making sure that we can cover everything. And, generally speaking, we go through that on a call with a client from the outset. I think clients a lot of the time are quite surprised at the detail that will go into at that stage, because look, we've said to clients before, this deal doesn't quite stack up, so there might be something better out there. And I'd much rather give that advice to a client rather than just willy-nilly fly in and just go, yeah, sod it, we'll do this and earn some money out of you. I'd much rather work with that client long term. And if they're going to stumble at the first hurdle, that kind of stops that from happening. So I don't really want that to happen. So yeah, try and go through a decent amount of detail at the beginning there, which hopefully that was useful to people that haven't been through that before.
Oh, chef's kiss. Absolutely spot on, mate. Fantastic. Love that. Guys, we're going to get
I hope
round
that
to,
makes sense as well.
yeah, it does. To be honest, mate, it's so I love the way that you present it, because I feel like I'm actually on that journey, and I can sort of, it's like having a conversation with you in your office based on what we're going to
I
do.
am I am in the office.
Well, there you go. And it's I love the concept of reverse engineering. We hear that a lot at the moment in property, and it really seems to be sort of a fool's avoidance tactic. Probably that's completely the wrong terminology, but what I mean is it's like it decrease. There's your light again.
Yeah.
Didn't like what I was saying. Um, it,
Not
it
animated enough.
to reverse engineer it in my head reduces any potential risk because you've analyzed them right from the end game, which is where the majority of the risk come is because you want this finished product, you want the finance to be released, you want, all this stuff to happen. So if you start at that point and then work your way back, you can sort of navigate those risks. And that's why I
Yeah.
love the way that you present it because it does allow you to sort of foresee what's going to happen.
And do you know what? This is what I'm about to say might be a little bit controversial, but it doesn't change that it's the truth. The bridging gets a bad rep. And when I speak to anyone and they don't like bridging, I go, why don't you like bridging? They're like, well, if you don't repay it in time, you get all these fees, and you get all this extra interest, and they just try and repossess your house and all this kind of stuff. And I'm like, right, number one, you signed a document at the beginning that said all of this, so you're aware that this was going to happen anyway. And then I ask, so what went wrong? Like, why didn't you repay it in time? Well, um, the mortgage lenders were being, rubbish, and they weren't giving me the money that I wanted, and I couldn't. They wouldn't do it on a commercial val, or they wouldn't do this, or they wouldn't do that. I'm like, so did you check on that before you bought the property? Well, no, because it's obvious, isn't it? I should be getting that money. And this is it. This is it. Bridging lenders are not evil. Bridging lenders have no feeling whatsoever. They just want to make money. Like they're just businesses like any other. Um, people think that there's some kind of like pie, and if they take more of the pie, you get less of the pie. No, no, no. We all just win, and everyone gets something out of it. Happy days, right? That's how this life works. Um, and I think that's it. Is when you don't reverse engineer, when you don't check the exit. If you don't get, if you can't get out, don't get in. You wouldn't dive into a swimming pool if you knew that you couldn't ever get out of that swimming pool. You'd drown. You'd eventually get tired and drown, right? Or you get so wrinkly that your skin would fall off or something. I don't know. But you wouldn't you wouldn't do that, would you? So why would you do that with a bridging loan? Why would you not check before you've jumped into that swimming pool? Why don't you check that there are places where you can get out on either side? You would do that, wouldn't you? But why would you not do that with a bridging loan where there's not more at stake because your life's at stake if you drown? But you know what I mean? Like, why would you not do that when you
Yeah.
check? Do I have the ability? Because if you've got a deal, if you've got an HMO conversion deal, by the way, and it only works if you get a commercial valuation, number one, I would question whether that's a good HMO deal or not. And I've seen a lot of these deals, and they've come from property sources where they're like, this only works with a commercial valuation, but you can get one because I can get one. It's like, no, you've got 20 years experience, which is why the lenders like lending to you. But this person is a first time buyer, first time landlord. So the 4 or 5 lenders that on a 6 bed at HMO are going to give you a commercial valuation. They need more experience than that. They need more ownership than that. They want a personal guarantee to actually be worth something other than just one property. So they aren't going to lend to this person, which means they've then gone into a deal that they can only get a bricks and mortar on the back end, and then suddenly they're sitting in front of us because they got sent to that expensive lender or whatever, instead, and they just go, yeah, whatever, like we'll just take you at your word that you can get it rather than checking it. We will sense check that and make sure that actually works. And we've, to be honest with you, over the years, the amount of like mentors, sources that have had a go at me because they've been like, well, you've just told our client they can't, not going to get commercial valuation at the end. I'm like, yeah, that's what I said, because that was a factual piece of information that you haven't told them about. So why am I the bad guy here? Like, it
Yeah.
happens all the time, and it's concerning. And yeah, it just goes to show like why it's just so important to do that reverse engineering piece, to just sense check it, and just put some contingency in as well. Don't go for the most optimistic. If anything, go for the most pessimistic, just to make sure that it still stacks.
Brilliant. Right, we'll go to some questions. Um, Leander, how often have you seen a commercial valuation go into negative equity on the refinance 3 to 5 years later when the initial deal has ended?
I can't think of one off the top of my head. Um, so I'm guessing what we're talking about there is we got the commercial valuation. on the initial refinance, but then when we came to then refinance it again 3, 5 years later, when that initial fixed term was up, for whatever reason we couldn't get a commercial valuation, it had to go to a bricks and mortar. I can't think of a single example. I don't think that it happens that often, but I definitely think it's something that you need to consider, particularly when you've got such a big disparity between, the commercial valuation and the bricks and mortar. If there's like a 20% difference, and in some parts of the country there is, like the yields are just so freaking good that the commercial valuation is incredible. On those, by the way, as well, if there is a massive difference, if it's generally more than 20%, some lenders will limit the amount they'll borrow you. They'll lend to you for that reason. And I think that's actually good. They don't want to overexpose you for exactly, what's been said there. You don't want to end up in that situation. So it's sometimes best to sort of hedge your bets a little bit, be a little bit less risky. You can still take risks, but make sure that they're calculated risk and you're accounting for them. And I think like the double whammy you could have there is, lending dries up a little bit with appetite for commercial valuations for a six bed, and there's a bit of a drop off in the property market. That potentially would be a situation where you would end up in getting into negative equity. I think negative equity is an extreme. I think what I'm kind of more thinking about is if you took out a 75% loan to value mortgage against the commercial valuation, you couldn't get the commercial valuation next time around for some reason. You might be at 85%, 90% loan to value. There aren't any HMO mortgages kicking around at 85, 90% loan to value. So you at that point would have to make a decision. Do I sit on the lender's standard variable rate that might be 6, 7, 8%? In some instances, it's 9 or 10. Do I pay down my mortgage with money that I had stacked away for my next investment, which means that slows everything down, or do I have to then sell, or I sell the asset? They're the three options that you then unfortunately are left with, which none of them are ideal. But you've just got to try and pick the lesser of the evils to for your personal circumstances. But that's what we're trying to avoid basically. And I think they're the conversations we tend to have with our clients more often than not. Just at least making them aware that that's something that they just want to be kind of mindful of, particularly in certain areas of the country where we've said with even this week, not this week, it's Monday, last week, I had spoke to a lender, bridging lender, and they were saying, at the moment we are being a little bit our appetite to lend in sort of the Merseyside area and in and around Bradford has dropped off a little bit because they've just seen quite a lot of this type of property, and they're not valuing as well as they maybe were a while back. So lenders are savvy to this. They do look at different parts of the country and where the appetite is for the types of properties you're creating.
Great. Addy sent a question in. Does Grand Union offer finance for the purchase as well as the refurb to convert from a 3, 4 bed to a 5, 6 bed HMO?
Yeah, absolutely. So this is funny enough. I wrote a post about this. Actually, I've written 3 posts, I think, in the last week across different platforms, all on this subject of the where people see the or don't get what kind of development finance refurb bridging is in comparison to a normal bridge. So a lot of people think it's two separate products, and it's not. So you get a standard bridge. That's very much like a short-term mortgage. So 75% loan to value, you fund the works. A refurb bridge or a development finance loan covers both. So you get the overall facility, which will be limited by one of those limiting factors we mentioned earlier, loan to GDV, loan to cost. And then that will be split into two sections. So a development facility, which is drawn down in stage payments, and a day one net advance is the terminology. We like our sexy terminology in the world of finance. So it is all one facility. And yes, I would say that type of finance, the refurbishment bridge, is probably the number one type of finance that we arrange for clients. It's probably not actually, probably just like remortgaging, because obviously we've got lots of clients and they've got lots of property. So every week we've got 10 people that need remortgaging of a property again. But in terms of acquisitions, that that is the type of finance that we arrange the most, I would say. And it's a great product, and it's just not as expensive as full on development finance, even at some of the other costs. like with development finance, you would need a quantity surveyor to go out. Refurbishment bridges, you just need kind of like either it's someone in house at the lender or it's an asset manager, and the cost of that is half. Some lenders might even offer desktop valuations, dual representative legals. You don't get any of that stuff with development finance, but it's quite normal in the world of bridging. So these products are great. I can do a quick plug actually. We are actually uh, ready to release within the next couple of weeks a development finance playbook, a sort of a guide you can download for free, and that covers kind of exactly how development finance work and refurbishment bridging into that, and all the different use cases for it, of which the HMO forms quite a big part of that. So yeah, I've been working on that like for 2 months,
Can't wait.
rewriting it, trying to make it so I didn't want to just put it into Chat GPT. I wanted to write it myself, make sure that it was in real person speak. But yeah, that will be coming out in the next couple of weeks. So hopefully that'll be useful for people.
Yeah, we can't wait for that. And please share it in UK Homes Network. There'll be a lot of people that want to get their hands on that. Leander, please don't apologise. Your questions have been amazing. We've really appreciated them tonight. So if you've got any more, please do keep firing them in. But we'll get round to Paula's last question. And then if you want to reach out to Sam, then Sam will tell you how you can do that. But he is quite active in UK Homes Network, so you can drop him a message at any time during the platform, and he'll come back to you. Isn't that right, Sam?
It is indeed. It is indeed. I need to post more. I tell you this every time. I need to post more. But
You stepped it
yeah,
up in the last few weeks. I've noticed. Yeah, yeah.
yeah.
It's good, mate. It's really good.
Doing my best. Doing my best. Trying to. Do you know what though? I know we talk about this. I enjoy sharing what I know with people. It's there's no greater thing than either you're on the phone to somebody, or I do a lot of voice notes on WhatsApps with clients, future clients, etc. And when you see them, when something that you've said has excited them about a project that they're potentially looking at, nothing beats that. That's awesome, because then that you've had such a positive impact on that person in that moment. So yeah, I get a lot out of it. It's not a selfless act. I enjoy it.
Amazing. No, that's the way forward, mate. Giving value, and a lot of people really, really appreciate it. So Paul has asked a question: can students get a bridging loan with deposits for fees ready to buy a first house with view to turn into a HMO later?
It's going to be hard, and I'll tell you why. It's to do with the exit. So um, if you when you're approaching a lender, let's say we're going to go down the route of getting one of those refurbishment bridges, right? Lenders will look at, in the same way they will on a development finance loan, three things. They'll look at your experience, they'll look at your assets, and they'll look at your income. Now, if you're a student, you're unlikely to have any of those. So it's not necessarily to do with the fact you're a student, it's the fact to do with what's your situation. Have you got any experience doing these conversions previously? No. Have you got any other assets in the background that, if something were to go wrong, you could potentially raise some extra finance from to help plug some gaps? Or do you have a really, really strong income, or I should say, do you have a really strong income where, again, if something went wrong, you're in a strong financial footing to enable yourself to be able to plug some gaps financially there? Students are unlikely to hit any of those parameters, which is just going to limit lender appetite, really. They're going to see that as a massive, massive risk. Then on the flip side of that, you're looking at the exit. Most of the time with an HMO, I mean, I have got one client who just converts HMOs and sells them. Like that's his strategy. He enjoys doing that. I've said to him for years, like, why don't you just keep a few? Like, do one off, one on. Like, just keep a few. But he doesn't want them. He doesn't want the hassle. But he's got a good market. But most of the time you're refinancing. So then a lender's going, okay, well, what's the likelihood of you getting an HMO mortgage? And actually, there is probably, I know we've kind of running out of time. I think there's one thing about funding that people get, HMOs, people get a bit confused with, which is what type of finance should you use, when and why not? Because a lot of people say, why can't I just use an HMO mortgage? Why can't I just use a buy-to-let mortgage? So I will quickly touch on that after this. But a lender, when a bridging lender, whether it's standard bridging or refurbishment bridging, they're looking at how they're going to get their money back. We call it an exit strategy. And a barrier to them getting their money back is you not being able to get a mortgage. Now, if you have none of those things that I just mentioned, the experience, the assets, the income, particularly those last two when it comes to mortgages. The assets generally is experience paying a mortgage or experience being a landlord, and you have no income, and a lot of lenders will have a minimum income requirement. Rental income can be included in that, but they have a minimum income requirement. If you don't have those, your mortgage lending options are so limited, if not practically zero. And again, a lender's just going to go, this ain't going to happen. So long story short, it's not to do with you being a student, it's to do with what your personal situation is at that point. If you can show that actually you do have some assets, even though you're a student, you do have some income and all that kind of stuff, then there is the potential for doing it. A lender wouldn't say, right, because they're a student, we're not lending to them. They would look at what is their situation. And that's the key, I think, there.
Brilliant. Guys, I'll put the link in. If you want to join us this Thursday in Manchester City Centre, where we'll be taking over a nightclub, please hit the link and you can still get tickets now. There's going to be two incredible panels, food, drinks, 20 exhibitors. We'd love to have you there. So please do. If you've enjoyed this webinar tonight, you can watch a live version with some of the panelists on our live webinar panels in Manchester, and there'll be lots of amazing people there for you to network with. So you can take all the digital into real life, and we'd love to see you there. If you can't make it to Manchester this Thursday, please share the it's getting to that time of night. Please share the love with Sam, and we've loved having him on. Please tell him how well he did on tonight's webinar. And if you have got some HMO projects that you're working on, we would love to see some photos of them in UK Homes Network. So make sure you download the app and get posting. Yeah, we always love a before and after picture. So if you're doing those conversions, let us know.
Yeah. I don't think I've shared it, but I'll share the YouTube video of my client's HMO conversion, the finished product that we did in December. So I'll share that in UK Homes Network either tonight or tomorrow morning.
Great. And Corin's asked a really, really, really important question. Where can
Yes.
we find you, Sam?
Obviously, you can find me on UK Homes Network, so download that. Just type in my name, Sam Norris, and you will find me on there. Drop me a note on there, and I'm happy to help. Over and above that, I'm quite active on Instagram. You can find me at the Sam Norris on there. That's N for November, not M for mother, as a lot of people get mixed up. I also like Chuck and Lando. That's the Norris I am. Yeah, find me on there at the Sam Norris. I reply to DMs usually within about 5 or 6 hours on there. And then if you just want to shoot me an email, you can. Sam at grandunion.finance. Nice and simple. There we go.
Brilliant. Great stuff. So yeah, Corin, please do reach out to Sam. Thank you very much, guys. We've loved having you, and we will be announcing very soon much more webinars coming throughout the year. So every week, every Monday or Tuesday, we are planning to do a webinar, and I've been speaking to some incredible webinar guests over the last few months that are going to be coming on. So please do stay tuned for those. You can get all the webinar dates in the UK Homes Network events tab. And of course, if you want to go back and watch Sam's previous webinar, I would strongly recommend it, where we talked all about commercial to residential conversions, then and how to fund those. Then you can watch that for free in the on-demand webinars tab. Have a lovely rest of your Monday evening. And for those of you that are coming on Thursday, can't wait to see you there. And I'll catch you very soon.
Ciao for now.